Hello, and welcome to Financial Insider Weekly. I'm your host, Michael Gray, CPA. My guest today is Peggy Martin with the Family Wealth Consulting Group. And Peggy is a CLU, has many years in the insurance business, but she's also a fee-only financial planner. And relevant to our discussion today, she is a chartered advisor for senior living.
Correct.
And today, Peggy and I are going to be talking about long-term care insurance. So what's going on is, of course, we have an aging population. More and more people are requiring long-term care. People in Peggy and my age group are dealing with senior parents, and so we're wrestling with these issues. And so what we thought would be appropriate to talk about it today. So, Peggy, with that, I would like to go ahead and get into our first question. But welcome today.
Well, welcome and thank you for having me today. I look forward to being able to answer the questions and have a conversation with you.
Good. Well, thanks a lot, Peggy. Okay, so I guess the leading question is, why would someone even consider getting long-term care insurance?
Well, long-term care insurance can help the individual to have peace of mind. It can also help the individual not to feel like they're being a burden on a family member or family members or their friends. It also helps to make wise choices about medical care. Most of the better long-term care insurance contracts have care coordinators attached to them, so to speak. These care coordinators are not hired by the insurance company, but they are available to each individual who has long-term care insurance. And these care coordinators can help you make very prudent choices about your health care. There's many options out there, so it's very difficult to know what might be best for you based on your health circumstance. Additionally, it does help you from eroding all of the assets that you've worked so hard to create all your life.
Yeah. When I've dealt with insurance issues, I mean, this doesn't relate to healthcare, but I guess it's a similar sort of thing. I was looking at disability for myself, and what I found out was one of them had the electric windows, and one of them had the stereo, and one had the air conditioning, but it seemed like there were different combinations for different policies, and so it was hard to compare one to the other, apples to apples.
That is true. That also can be true for long-term care insurance. It's very specific to the individual need, the asset base of the individual, how much free cash flow they have to pay for premiums. I do an in-depth fact-finding with clients when I work with them on their long-term care needs and make sure that we're working with something that's appropriate for their situation.
Good, okay. What health care services are covered by these policies?
Well, the big ones that are covered are nursing care home care, which is really important anymore when you're looking at a contract to be sure that it does have a home care provision to it. Most of us want to be treated in our home, or at least we think we do. That could change as health deteriorates, but I think most people want to start out with the home care option. Also, adult daycares are covered. Assisted living facilities can be covered. And additionally, respite and hospice care can be covered. It depends on each contract, what the provisions are, but there is a lot of flexibility in the contracts.
Okay. Who qualifies for coverage under a long-term health care?
Well, that one can be difficult. There's two reasons why you would not qualify for long-term care. The easy one to explain is that you just don't have enough financial well-being to apply for long-term care. And that would be people who are probably making incomes or have incomes from their retirement investments of $20,000 a year or under. You would really want to be looking at, gee, do I need long-term health care, or should an agent be selling you long-term health care? Probably not. The harder one, though, to pinpoint is the medical issues surrounding getting long-term care insurance issued. What happens with that is an application is taken and many questions are asked about what kind of health issues you've had, what kind of medications you're on, do you need any kind of assistance currently? In other words, are you using a cane, a wheelchair, a walker, any of those types of things? then a complete review of all of your medical records are done. And additionally, for people under the age of 70, a telephone interview takes place by the insurance company. And if you're over the age of 70, most of the companies that I am currently working with actually come out to your home for a physical interview. They want to see who you are, what your lifestyle is. And again, our society is geared to still age 65 being the normal retirement age.
Yeah.
As that starts to change over these next few years, we may find that people that are in their 70s are not perceived to be old anymore. Current standards, people in their 70s are still considered old, especially by insurance company doing underwriting.
And we talked about this recently. I was with some people and we said 70 is looking younger and younger. And I said, yeah, younger and younger as we become closer to 70.
You bet.
So related to this, though, is there a physical examination like for life insurance?
No, there is not a physical, or I should back up on that. I have never been asked to have a client have a physical. I have been asked to have clients recomplete questionnaires again because the insurance company is wanting clarification on some kind of medical underwriting. But normally either they take the case or they do not take the case. There are some companies that will actually have a rating classification to them, but most it's either you're going to qualify or not qualified. Most of the companies that I'm working with have what they call a preferred rate, which means that you're cream of the crop, you're fortunate, nothing is wrong, or there is a standard rate, which means you're still doing very well. You don't have anything huge that's going on with you wrong. Maybe you're taking high blood pressure medication, you're on cholesterol medication, something like that, but nothing hugely wrong. Recently I've had one person declined and also had one person get a preferred rating, both females, both in their 60s. So it does show that both things can happen. It just depends on individuals and what's happened to them.
All right, now here's the big one that's on a lot of people's minds. Aren't the premiums for these policies, long-term care insurance, aren't they significant? And how can one justify the expense for this insurance?
That's a good question, Mike. Yes, I hear that a lot when I'm talking with our clients about the possibility of purchasing long-term care. One of the things, though, to keep in mind, and it's even on the AARP website, is that the expense of long-term care, if you need that, is immense, and you can erode all of your assets. There is a potential to do that depending upon your asset base. Of not having any assets by the time you get done paying for your long-term care, and if you're married, maybe your spouse's long-term care. But to put into perspective costs, in the state of California right now, a semi-private room on an average basis in a nursing home is running about $80,000 per year.
Wow, that's a lot of money.
That is a lot of money. And this woman that I recently placed a policy for, again, she's age 64, preferred health, has a contract that has a lot of good benefits to it that will help to protect her assets and also provide dollars to help pay for her long-term care needs. She's paying about $8,000 a year for that coverage. So I look at that and think, okay, which would you rather do? Would you rather pay $8,000 per year or know that you could have an expense of $80,000 per year based on today's dollars, $2009? Which would you rather have? And the contracts I work with have an automatic inflation built into them, 5% compound if under the age of 70. That seems to be the magical age with all these contracts. If you're over the age of 70, you can choose 5% compound, or you can go with 5% simple interest rate. So that makes a difference, and that accumulates each year whether you are on claim or not on claim.